In today's video, I want to discuss mortgage rates. Who sets mortgage rates? What's the deal? Let's get into it.
1, 2, 3. Caminando, sembrando ley, caminando por el mundo del rey, toda la cosa que...
Mortgage rates are notoriously difficult to predict. They rise and fall based on market sentiment, headlines, and a variety of economic indicators. The Federal Reserve does not set the mortgage rates necessarily, and the central bank's decisions do not drive mortgage rates as directly as they do other products like, let's say, CDs or savings accounts. But the Fed's actions do indirectly influence the rate consumers pay on their fixed rate home loans when they refinance or take out new mortgage. So the Fed has indicated it plans to keep rates low at least until 2022, despite a brightening economic picture and a jump in inflation in recent months. So why is the Fed remaining so accommodative in the face of higher inflation? They still believe inflation is transitory, and notably their unemployment forecasts were little changes since March. So while the economy and inflation have revved up in the eyes of the Fed, their assessment of the jobs market is not much different now than it was in March. So what does the Federal Reserve do on paper? What does the Federal Reserve do on paper? The Federal Reserve sets borrowing costs for shorter term loans in the U.S. by moving its federal funds rate. The Fed met Wednesday to discuss the funds rate, which is currently set near zero. The rate governs how much banks pay each other in interest to borrow funds from their reserves kept in the Fed on an overnight basis. So mortgages, on the other hand, track the 10-year Treasury rate. So changes to the federal funds rate might not move the rate on the 10-year Treasury, so which are bonds issued by the government that mature in a decade. So though a Fed's rate cut doesn't directly push down yields on the 10-year, it can lead to the same outcome. So investors worried about the economy after a rate cut might flock to the 10-year Treasury, considered a safe haven asset pushing down yields. So the Fed also influences mortgage rates through monetary policies, such as when it buys or sells debt securities in the marketplace. In early March, for example, the pandemic caused severe disruption in the Treasury market, making the cost of borrowing money more expensive than the Fed wanted it to be. So in response, the Federal Reserve announced it would buy billions of dollars in treasuries and mortgage-backed securities, or MBS. So the move was to support the flow of credit, which helped push mortgage rates to a record low in the days and weeks that follows. So what influences mortgage rates? When we look at fixed rate mortgages are tied to the 10-year Treasury rate. When the rate goes up, the popular 30-year fixed rate mortgage tend to do the same, and vice versa. So rates for fixed mortgages are influenced by other factors such as supply and demand. When mortgage lenders have too much business, they raise mortgage rates to decrease demand. So when businesses is light, they tend to cut rates to attract more customers. Price inflation pushes on rates as well. When inflation is low, rates tend to lower. When inflation picks up, so do fixed mortgage rates. The secondary market, where investors buy mortgage-backed securities, play a role. So most lenders bundle the mortgages they underwrite and sell them in the secondary market to investors. So when investor demand is high, mortgage rates tend a little lower, and when investors aren't buying, rates may rise to attract buyers. So what Fed rate decisions mean for mortgages? So the Fed sets the federal funds rate. This is an interest rate applied to the money that banks and other depository institutions lend to each other overnight. So the Fed funds rate affects short-term loans such as credit cards and adjustable rate mortgages, which unlike conventional fixed rate mortgages, have a floating interest rate that goes up and down when the market on a monthly basis. So long-term rates for fixed rate mortgages are generally not affected by changes in the federal funds rate. So if the central bank wanted to reduce rates again to stimulate the economy, it would have to push rates into negative territory, a move that Powell, the Fed chairman, has said is not being contemplated. We'll see. So what to consider if you're shopping for mortgages. When you're shopping for a mortgage, compare interest rates and APR, which is the total cost of the mortgage. Some lenders might advertise low interest rates, but other, offset them with high fees, which are reflected in the APR. To begin your search, compare offers online, read lender reviews, go directly to lenders' websites. If you have a relationship with a lender, bank, or credit institution, find out what interest rates of the customer's discount you might qualify for. There's always a discount. Often lenders will work with customers to give them a better deal than they might otherwise get at another place. So mortgage rates are cut above historic lows right now. So while you should pay attention to the Fed and the economy, your best move if you need property loan is to get a rate that suits your budget and goals. It's competitive out there. I refinanced 9 properties over the last year and a half, and I do have a relationship with 2 institutions, and I pretty much went with those institutions, but on one specific loan, an outsider bid and came in and beat everybody. So, it's always a deal. When you hear no, you hear maybe. And I was able to, get an unbelievable rate on all the properties and lower the rates from where they were, and also pull cash out on specifically one to invest in another piece of property outside the state of California. And I have relationships and called over 40 lenders when the pandemic hit, and learned a lot of interesting things about the cash out option and what lenders are offering cash out. Because as you know, when the pandemic hit, all of a sudden credit institutions tightened up in March, and they said you have to have a 700 FICO score and 20% down. Well, why weren't they tightened up before the pandemic? So they were doing some risky loans, of course, and I called over 40 lenders, and a lot of these lenders, people were saying they weren't doing cash out, and these big institutions, like let's say Wells Fargo, and they said you'd have to have $250,000 in your bank to do a cash out. Well, a lot of other folks were allowing it, so it was going on, and I'd argue up to 40% of loans were cash out. As I said before, the good thing about this market this time around compared to 2008 is people have higher equity, and there was more inventory back in the day. So cash outs are happening. Inflation has happened. The Fed has seen it as transitory. I don't agree with that. It's been going on longer than a few months. You don't have to look too far to see what's going on. So there is some concern. So the Fed is talking about it. They're saying no cause to panic right now. But the rates are still low. They're saying to 2022. Some people are telling me differently, so we'll have to keep an eye on that. It's interesting times to be alive. Take care. Be creative.